quiet when they scared, I sell it when they greedy. I'm always asking why, price always has a meaning, and I always been that guy. If you need to come and see me, turn it to a 5. I'm the opposite channel Dini.
All right, ladies and gentlemen, I got your watch list coming in of February 21st, 2020, and the stock market went crazy today. Today was very important, and it's bringing up a lot of concerns. We need to talk about what happened here. It wasn't that big at first, and then it slowly turned into something. We watched this all day. Today was a very, very weird event, and you saw it across the board on a bunch of random stocks. Some felt it more than others. There was this weird flash crash event where they lost a lot of value in literally a 5-minute time frame. There was a lot of downward activity, so I want to talk about that, and then I'm going to go over a play I made today, another one of my crazy small plays, and how I plan to turn $150 into $75,000. So it's not as if I'm intending to do this in the sense where I'm like, yes, this is the only option. I bought this as an insurance play. I do know the probability. Hopefully you know the probability, and hopefully you guys are able to learn from this in our paper trading. And please understand too, option trading, assume the risk you can lose all financial advice. Please don't financial advice. No purpose only. Thank you. But I'm going to go over this play. It is a low probability play. There is a literal play that we made. It is a defined risk. Most you could lose is $150, and the max gain is $75,000. Now, the reason why I took it today is for the reason that caused this drop, and I want to explain it, but also there's something very unique with the contract prices considering the last few weeks we've had. So I'm going to share that with you. Pretty much the spoiler is we've done a trade like this before, but this trade is offering 3 times the payout with the same crappy probability. So let us get right into it. Drop your thumbs up on the video. Make sure you guys are subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open. It's the first link in the description, and it is pinned in the comments. We better see you there in the morning. It's free 99. It costs you nothing to join. All we ask is that you are positive and respectful, but you can watch all of these plays made today that we made. Again, we're recapping it here, but we did all of these live so you could come see this happen in action. You could be there when the market's dropping. We're giving you guys updates. We were explaining this, and I did explain the reasoning here today live that I'm going to share with you. And I forgot too, we have another play too. I'm going to go over that beyond play that I'm excited for next week. But yeah, be there live. I mean, please, it costs you nothing. We love you. Just show some love, baby. And the most important thing you need to do, post your watch list below. Let us know what you're looking at. You got any plays, comments, remixes? If you have any ideas on this play, you could give your feedback. I already know some of you guys don't like these plays. Some of you do. But again, we still love to hear from you, baby. So let us get right into it. The thing we need to discuss is this drop. And now, a lot of people had many reasons for this, and there was no news. This was not caused by any event. There was nothing. That is the confirmation. Even after hours, everybody is trying to explain it, and the only explanation is giving everybody's explanation, which is kind of crazy, but this was very unknown, kind of worrisome, but I like it. I mean, it has to do with a lot of the stuff we're looking at, and I like it because it is clear now that we're going to start getting this weird divergence, and things are going to play out. But here's your answer, my friends. Bonds. We are balling off boring, baby. Nobody likes the bonds, but the bonds reached a record low, and this is what I want to show you guys. I'll pull it up here on the chart in a sec, but there's a new range being set, but the real question you have to ask is why bonds? So bond yields go down when demand for bonds increase. The more people want bonds, the higher they pay for them, the lower they yield. That's the quick synopsis of that. But the question is, why would you go into a fixed investment? Why would you go into bonds? If earnings was so great, if the market is still offering opportunity, we got this crazy melt up, everything is great, why would you go into bonds? The same question, and this is what some people thought the reason was. It was gold. Gold shot up today. Why would you buy something that doesn't move too much in value every year when the stock market's going up 5-10%, or you could get dividends? Why would you go to these assets, and why are we seeing a lot of people buy them, and how do we know a lot of people are buying them? The rates are dropping, and this is important. So we brought this up with TLT. If you've been watching, we've discussed this last few weeks. We had those April TLT plays. Those might get a little crazy for us. They went up a little bit today. They're still looking good. But again, that is the question. Why are bonds going up? Well, going down, TLT goes up. So that's the first question. But this is what I want to show you guys. This is all you really need to know and understand it. I mean, this is a good visual representation. Here's the 10-year bond, but take a look. You know, we're at this level. We were at the low there early in February, but last time we were at these lows, there was October 2019 and then August 2019, and then again, that July 30th to 2019. This is the last time we hit TLT, but Look at before that. Every single time, I mean, guess this is how something trending downward is supposed to look, but this is why this caused this reaction and is getting a little bit fearful. It's moving around the yield curves, but ever since, literally the beginning of 2019, and think about the environment we were coming off of, it was the same thing in October 2018. I only have this on a 1-year chart, but bonds were hitting a new low, and then finally they bounced off there. Then a few months later, bonds broke through a new low. They kind of set a new range that then that support level became resistance. And then what happened, and 3-4 months later, it hit a new low. And then this was from May all the way to August. But then the market didn't really start puking until August after that second rate cut thing. But every time the market breaks new lows with the bonds, this is something that it's telling you how money is pretty much piling into this. And part of it is the Fed as well too. But this is what's happening, is that we haven't done this cycle of breaking a new historic low on bonds in a while. I mean, last time was August, and then October, we did briefly test it here with the coronavirus stuff. Again, think about this coincides with everything in the virus. The bond market has been telling us more about it than oil, surprisingly. But now this is what I believe. This is my take on it, and this is I'm very confident in this. Maybe confidence isn't bad to have. I don't know. But though it's the fact that bonds are leading the way. Our view with oil and everything, it's not really showing as much because oil's been bouncing. But this is what I believe investors are worried about, and this is what will lead computers to automatically start repricing stuff, is if we hit a new level of bonds. Because the minute we break through one of these lows, usually we haven't seen it, but in the past it's shown us when we kind of hit a low and then test and then bounce up for a few months and then test it again, we usually break through, and then this will pretty much become the new support on the upside, which will change a lot about investments and what this means about the market and what is available. So this is the number one reason I believe. So again, it's why are people globally piling into bonds, and what does that mean? And another thing to look at, and this is also the next thing, this is what I brought up to you guys a few days ago. This was last edited 2 days ago. These were your keys from the watch list, but I said earnings next week is important. TOT at a crucial level. That's the bonds, but I said watch out for the important pop-off indicators, and that's going to be either the yuan or the Shanghai Composite making a move, oil or bonds. We saw a big move in bonds in the last 2 days, and now today we saw the yuan, which is, again, even more interesting because it's breaking past that 7.0 level. Now it's going 7.05, but last time it was here was, again, end of 2019. We saw that briefly there, but before, there was usually problems. Again, take a look. The yuan's almost at the same level where August starts creeping around, and then when that rate stuff in the bond started to shoot up, look what happened to the yuan. It went from this level all the way up to its weakest in about a week or 2 weeks. So this is an important one, but again, just the size of it, the fact that it moved 0.5%, and then now this one stuck out a little bit weird, but we saw this yesterday. The Japanese yen popped off, and again, it did it today, but now this is weakening, and now this is concerning because I was expecting it to strengthen, and weakening is good, but not in this case, because now this is the next big key to watch. And again, these are all global indicators. If this doesn't make sense, keep your eye on them today, and you'll see. But we're going to talk about this a lot. We don't all the time because you usually don't see all this stuff happening, and this is the stuff we're running into, is the dollars again. And now this is, it's approaching that $100 mark, but this is where it gets a little wild. I mean, if we pull it up, I need to go back a few more years, but anytime we've gone up through this level, 2014, that was the oil crisis in October through that. But essentially, the dollar is going to start going up. That would make sense with the USD JAPY weakening. And then also now, same thing with the yen because the dollar's getting strong. And this could all now point to the coronavirus stuff. But also, again, this is now, it's just saying we don't know what's leading. So now this is what everybody has been talking about. This has been the number one question that everybody was trying to answer was, why did this occur today? It's very hard to explain, but it could have been the debates. That was one thing people saw, the strength of Bernie Sanders and Elizabeth Warren. They said Wall Street didn't like it. Some people have pointed to the futures market during the debates. That could be it, but I don't necessarily think so. It could be the coronavirus concerns because now it's spread more to Japan and Korea. You saw 2 more deaths in Japan, and they were even linked to the Carnival cruise ship, and then Korea. Now this is showing the outbreak is going to these other countries, and the speed of those outbreaks and the larger deaths, it's signaling pretty much a bigger outbreak, and people are starting to get worried. And then it could have also been profit taking, and then some people could have just been saying that this is it, we're capping out because of earnings. Remember, Apple did cut guidance the other day, And now this is even seeing the digestion. But at the end of this day, is it like coronavirus? And some people even believe that the market is just mispricing the coronavirus. And that could be it. This is why maybe that's why people are piling into bonds. When we answer why people are going into bonds and we're seeing bonds lead the way, that will explain everything. But the only new thing we saw was the debate in bond yields. So essentially, the virus spreading, people worried about the virus, even what Apple has been saying and all that was new. People taking profits during earnings, or people now, they've had multiple opportunities to sell out, and we're not necessarily seeing too big of institutional sells. But the question is now, which one of all of these is new? It was the debate. I don't think it had that strong of an effect, but only thing new besides that is what the bonds are doing and the levels which they're reaching and the implications of that. So that is what caused all of this today. That is what I'm going to be looking at here in the future, and it is going to start getting crazy. It's already been crazy. Volatility is most likely coming back. This could be either a hint for the coming weeks, or we might see it happen right now, or it could be a little bit of a glimpse of it now, and then by the next Fed meeting we see it. But I would be on watch. We have to watch certain indicators and be careful, but at the same time, don't panic now. And this is kind of how we're playing these plays, because you got to be patient. You can't panic. You could get some really awesome deals, and that's what leads now to this crazy 1% play. So I'm going to go over this play, but there is a few keys that we need to discuss about it and why I like it. And like I said, I'll start with the spoiler, because this is the reason why it kind of stuck out to me, that the March contracts are a lot more attractive. And this is something you guys have to know, is that now that we've had the Wuhan concerns, imagine that first drop from the Wuhan zone, then we kind of came back up, and then we've spent so much time. This has killed premium, and it's changed the expectations. So now some of those contracts with more time closer to the money, the fear has dissipated simply because the move. So even if those risks are still there now, the market is not pricing them as strong, hence why we are susceptible to see a big move or repricing out of nowhere. So those plays are cheaper, and I could see that because you guys have seen me do some plays like this. We got about 28 days on the contract, so just under a month, which is my sweet spot there. But the March is more attractive because the same sort of trade of this nature should be paying out $20,000. It should be $150,000 to $20,000 on the max gain. The difference between the strike prices and how much we're paying and all that, it should only offer a $20,000 gain. Now we're getting the same 30 days we would want, but it's offering 3 times the reward at $75,000. So that's the first reason why I like it. But now let's go back to the first part. This is a less than 1% probability play. You need a 30% drop to be in the money and receive the max gain. So you can make more, you can make money without it going in the money. It doesn't have to drop 30% for you to profit on this. However, to get the full $75,000, you will need the market to drop 30%. But here's the point, is small amounts. And that's what I'm trying to do, is I'm using a small amount. You don't have to put $150 into this. You could do $3, or you could even just watch it. I mean, but literally you could do a $3 play that nets like $1,500 reward or something like that. So it could really be, in the most pure essence, a cheap insurance play. But again, if you chase these plays and do these a lot, you could kill an account. But if you have a big account, I mean, these are some decent insurances. But if you want to strategically flip these, this is what I plan to do, because we did this last time during the coronavirus. The point is to put a small amount in and flip the premium. If the stocks drop and we see some volatility return, the premium's going to go up, and we could either get it free or make it a ghetto spread. And that's what we did last time. We had a similar SPY play. That thing went up 300%. You could have just easily sold out of it and then rebought this SPY puts at a lower price, or you could have ghetto spreaded it and walked away nice. It's a little harder to ghetto spread it because it's a debit spread. But the point is, now there's going to be 3 stages of worry, and pretty much if fear picks up, those tier 3 crappy puts are going to gain premium no matter what. So now that the fears are kind of going up, what's going to happen? The first level of puts that are kind of realistic, those go up in value. But the ones 2 standard deviation, people are kind of like, it could happen, but not really. They kind of go up. And then these ones that are still further out the money, we're able to get a lot closer than when we had these drops. But now those are just written off completely. So those are the tier 3. But if we do start to see a drop, or we see volatility, those tier 3 ones might just go up out of nowhere. And if we're securing them at these totally unexpected prices, we could flip them for more. But again, I'm using this in a very, very small sense. These plays don't usually hit. They're not going to. Again, small insurance. I mean, it's a nice way to put $3 if you want some level of insurance, or find a way to flip the market. But I am going to look for different plays plays now that I have this play, it's going to open me the door to get some marches on individual companies, because now the premiums are starting to go up in value on the indexes while the companies are kind of staying the same price and getting a little bit more expensive, but not as much. But here's the play. It's a SPY March 20th. Buy 50 of the 235 puts, and then you sell 50 of the 220 puts, net debit 3 cents. So again, 50 contracts at $3 each. That is $150 total. So now how does this work? You have the put at 235 and you're shorting the right at 225. That's pretty much a $15 difference. So if each contract could make $1,500 and we have 50 of those contracts, that leaves us $75,000 max gain. And that's if the S&P goes down to 220 and we are now at 330. So it could happen. It couldn't. Some people say if you really zoom out on the weekly, it's possible. I mean, last time from October 2018, when the market was a little crazy, and the thing is, we've just gone up 10% since then. So it'd be an extra 10%. But at one point, this would have been a 20% drop. So it's unlikely, but not really likely. It's pretty crazy. But again, you guys know my logic behind it. I like sitting with my hand in the cookie jar there. So we will see what happens. So that is the first play that we made today. And then second now, well, I guess, let us get into the plays. I already got into the plays, damn it. But beyond, this is the next play I'm making. I like this play a lot, and we have time on it, so I might average down on it tomorrow, but I think the ideal time to average down will probably be Monday, just considering the earnings, but I got more time. This is what I told you guys yesterday. I did end up going big, but I pretty much did it like a medium amount where I put $700, so it's still kind of big. I got these 250 calls. I got 10 of them at 77 cents each, and it went up. They held their value a little bit today. They were kind of at 80, but then as all the market pressure came in, it responded. It didn't respond too much until that last flash crash, but I'm playing this as the earnings run up. The fact that the contracts even held value, this tells me something about beyond. So it's at least doing some of the earnings IV. The contracts aren't too inflated coming into all this. They did kind of have a pop-up here, but they've kind of done that move already here. So even though they have less time and they're at the same price, it's showing a little bit of premium, but they're not going too crazy just yet, but again, they're still far out the money. So that's why I put $700 in it. And the plan was, again, comparing that to the last NVIDIA, I put 2,000. So if I want to average down, I could triple the position up and get it at a different price, and I might consider that. But the idea here is I'm going to try to flip these 50%, get get $700 back, be able to keep like $300 in it, and hopefully we should be good on there, or maybe we could ghetto spread it. So that's what I'm going to do coming into the earnings, but we might need to average down on this. So I am planning to get more, but watch out for that coming into next week. And then another play that we made today, and this was a quick one off of the drop. We played UVXY, and here's how you guys could see how you could get some exposure to some of this drop, but also be cautious, because this is what I was worried about, was buying any downside exposure while the market was dropping. We did a February 28th UVXY. So after that first leg of the market dropping, I was getting kind of worried there. I was like, all right, I think we got it. No way, I think we got it here. It's the market was kind of coming up there, and we were losing money on the NVIDIAs and all that other stuff. We had some of our TLTs from April were working, but I was getting a little worried there. So what I did instead here, as it was coming up, I bought 5 of them for 10 cents, spent $50. They went up to like 15, 16 at one point. And as the market was hitting those lows and UVXY was going up, what I decided to do was I ghetto spreaded it with the 1750. So these came up here to 10 cents, even 11 cents. I was able to top tick it. But as UVXY was dropping, I bought 5 of those for $50. Now the 1750s were going for $10 each or $11. So I shorted 5 of these at 11 cents each. I got $55. So I made 10%, $5. But now I have 5 contracts with $1.50 difference, or $1 difference. That's a $500 max gain, and it's actually relatively close to the money. It just has a little bit of time, but that's how I was able to get some free put exposure. And this is pretty much moves like this, but with a little more time. This is what I'm going to be looking for tomorrow and also coming into next week. So keep your eyes out for that strategy, and again, try to make things free and just don't get caught paying too much for some of these puts. But besides everything else, I'm going to be watching the NVIDIAs. I'm still watching those debit spreads. Again, they flash crashed quick to 300. They still held up. Depending on the climate tomorrow, I may be cautious to try to get out of some of those. We still have our ghetto spread. and those went up a little bit. So watch those. I'm also going to be watching UAL. We're still down on those marches, but I still want to see how this plays out, because if it is coronavirus, we're going to see it more reflected through the travel stocks. But again, this is what I'm saying with the option prices. All of these options with still 30 days of time, they just got a lot cheaper. So this is, I mean, if anything, tomorrow might be our time to strike put protection. Unless the market, if it blows off this volatility, then you're really screwed. But watch them. I'm going to watch Carnival Cruise Lines as well. They're at a new low, but again, keep an eye out on the contract prices. I like Yang. I saw some today. Even though we didn't get them the other day, they're kind of leveling out. This is pretty good. There's still some near the highs for like $50, $60. The only thing I'm worried about is the spreads and kind of the liquidity. SCO is kind of a little bit expensive, so we need to find a play on oil. But if anything, I'm more moving towards playing the China stocks and that, but then also looking at more TLT, whether it be short-term, and then keeping those long-term Aprils that we have. So watch out for that. Then watch Apple. This one was interesting. They're dropping after hours, it looks like here. Actually, they're down a lot after hours. And, well, this was one of the reasons I wanted to look at them. I also want to watch Boeing, keep an eye out for them, but then watch Microsoft. And all of these, I mean, watch some of them more so towards the downside, some of the big leaders, but specifically Apple and Microsoft. The thing about them was Microsoft sold out a lot more. Microsoft was down 2% and some change. You see even right here, now they're down 1.7, but Apple didn't drop as much. So surprisingly, Microsoft sold off more. And remember, they had more meat on the bone, but keep an eye out for Apple, because if they start dropping even more, it could have been because they kind of priced it in a little bit with their guidance cut, but they were kind of the laggers. So the puts were actually a little bit cheaper there. So I was looking at them. I was even looking at Caterpillar today. Watch them. Watch OLED. We did an earnings play, and watch the live stream. At the end of the live stream, I gave, in the last at 15 minutes, we gave a rundown of this. We played both ways. Unfortunately, unless, we see how it opens tomorrow and downgrades, that play we're going to lose. I put $200. I grabbed 2 puts at $55 and then 1 call at like $80. They were decent within 2 standard deviations. It met the criteria, but surprisingly, OLED did not move as much. So we will see, but thankfully we got till March 6th on those. So watch them. Watch Dropbox. They had a good report. This one could be a good continuation considering the contracts were cheap. And another one to watch that went crazy today, Stamps. We didn't play this because I thought they're pretty far at the money. Same thing even with Domino's, but they both hit. These were 9,000% option plays. But with tomorrow being a Friday and the fact that they've moved up a lot, these could set up some good continuations, both Stamps and Domino's for tomorrow, maybe weeklies. I'm going to watch that. Unfortunately, HD went up, but they're popping out. This is showing a clear rotation. Watch them tomorrow. Again, you might see them carry off and make another. If the market drops, they have a lot of fuel to go up. But McDonald's dropped. McDonald's came up a little bit, but if we did that same credit spread on HD that we did on McDonald's, we would have won. But then also now watch Boeing. I'm still waiting on Boeing's moment to drop here. It's slowly been selling off, so it hasn't had a big crack yet. But maybe that comes tomorrow on the Fridays. It's at that level again. I might want to set up for some time on those plays. Then finally, watch UVXY and then watch some of the growth stocks. Momentum, really, they dropped the hardest during this, and that's something to pay attention to. Take note of all the names that did that. But Shopify and Roku stuck out, especially Shopify. Big bounces. This is good to play with the options, but pay attention to what they're doing in the price levels, and now especially Roku at that 120. But overall, I am going to be focusing on making a lot of quick flips to try to get free puts if we get some negativity. I'm going to space some things out with time, and then I'm really going to be looking towards TLT and bonds and trying to just get a clear signal and divergence to give us a green light to go ahead with either shorting or buying the dip. But that is your watch list, ladies and gentlemen. Make sure you're hydrated, healthy, ready to go. Make sure you post your watch list. Make sure we see you there in the morning. And remember, you need to keep the money. You came out with gains. We still got earnings. We got a lot here. The volatility is going to pick up. Now, you really need the helmet, baby. This is not a time to panic. Don't freak out. Remember, the best thing you could do to control any human weaknesses is use it with a down payment, a small amount of bargain. Do not forget that. If you control the budgets, it doesn't matter how uncontrollable your emotions are. Just let the budget and the prices speak to you. Control it. Go small. You only need a little bit, especially when there's a lot of volatility, baby. So I hope you guys are ready. Don't go crazy. Don't panic. Don't go nutty on the YOLO demon. Just control it, and we go to Froggy Friday. But the code loves you, baby. Let's go.